Gold just did something it hasn't done in over 50 years. And if you understand what I'm about to show you, you'll realize we're watching the exact same pattern that preceded every major banking crisis in modern history. I'm talking about a signal so reliable that central banks around the world are quietly positioning themselves right now, while most investors have no idea what's coming. Let me paint you a picture. Right now, gold is trading at record highs, smashing through resistance levels that analysts said were impossible just months ago. But here's what nobody's talking about. It's not just going up. It's going up while something very specific is happening in the banking sector. And that combination, that's the warning sign. See, gold doesn't just randomly spike to all-time highs. It moves for a reason. And when you look at the chart, when you really study the price action, you start to see a pattern emerge. Gold rallies hard when confidence in the financial system starts to crack, not when it collapses, when it starts to crack. That's the key difference most people miss. Think back to early 2008. Gold was climbing steadily, while Bear Stearns was still considered a solid investment bank. The metal knew something was wrong 6 months before Lehman Brothers collapsed. It was screaming at anyone paying attention, but most people weren't listening. They were too busy watching their stock portfolios hit new highs, completely unaware that the foundation was rotting underneath. Or go back further. 1971. Gold was trading at $35 an ounce, fixed by the government, but the pressure was building. The dollar was overextended. Foreign governments were demanding their gold back. And when Nixon finally closed the gold window, what happened? Gold didn't just go up, it exploded. Within 9 years, it hit over $800 an ounce. That's a 2,200% gain. And it all started with that same pattern we're seeing right now. Here's what's happening today. Major financial institutions are showing stress fractures. Not failures yet, stress fractures. Their derivative books are massive. Their exposure to commercial real estate is staggering. And their deposit bases, shrinking, fast. When depositors start pulling money out of regional banks, when they start questioning whether their money is actually safe, that's when gold starts to move. And it's moving right now. Let me give you some context on what's really driving this. Central banks have been buying gold at a pace we haven't seen since the Cold War. They're not doing this because they think it's a good investment. They're doing this because they're preparing for something. When the People's Bank of China adds to their gold reserves month after month after month, when Poland increases their holdings, when Singapore quietly accumulates, these aren't random decisions. These are strategic moves by people who have access to information you and I will never see. And here's the thing that should terrify you. They're buying while simultaneously telling the public that everything is fine. The official statements are all about stability and confidence, but their actions tell a completely different story. It's like watching someone install a state-of-the-art security system while telling you the neighborhood is perfectly safe. The contradiction is deafening. Now, before we go deeper into what this means for your money, I want to mention something quickly. I've put together a free guide that breaks down the exact strategies thousands of American retirees are using right now to protect their wealth from what's coming. It's in the description below. No cost, no obligation. Just information that could make a massive difference in how you weather the storm ahead. Grab it while it's still available. Let's talk about the mechanics of what's happening in the banking system right now, because this is where it gets really interesting. Banks operate on something called fractional reserve lending. Sounds complicated, but it's actually pretty simple. For every dollar you deposit, they only keep a fraction of it in reserve. The rest, they lend it out. They invest it. They use it to make money. This works great when everyone trusts the system. But the moment people start questioning whether their money is safe, the whole thing can unravel incredibly fast. And we're starting to see the early signs of that unraveling right now. Deposit outflows at regional banks have been accelerating, not making headlines yet, but accelerating. Here's why that matters. When deposits leave, banks have two choices. They can either sell assets to raise cash, or they can borrow money to cover the shortfall. Both options are problematic. If they sell assets, especially bonds they bought when interest rates were near zero, they're selling at a massive loss. Those losses eat into their capital. Eat into it enough, and suddenly you've got a solvency problem. If they borrow money instead, they're paying higher interest rates than they're earning on their existing loan portfolio. That's a profitability problem. And profitability problems become solvency problems real fast when they persist long enough. Either way, the bank is in trouble. And when banks are in trouble, gold goes up. Every single time. But here's what makes this situation different from previous banking crises. The scale. We're not talking about one or two banks with bad mortgage portfolios. We're talking about systemic exposure to multiple asset classes that are all under pressure simultaneously. Commercial real estate is imploding. Office buildings sitting empty. Retail spaces shuttered. And who holds most of that debt? Banks. Regional banks especially. Then you've got the residential real estate market. Prices are still elevated, but transaction volume has collapsed. People can't afford to move because they'd be trading a 3% mortgage for a 7% mortgage. So they stay put. And that means less economic activity. Less activity means less revenue for businesses. Less revenue means more loan defaults. More defaults means more pressure on banks. And we haven't even talked about the derivatives yet. Oh, the derivatives. This is where it gets truly frightening. The total notional value of derivatives in the global banking system is measured in the hundreds of trillions, not billions, trillions. These are complex financial instruments that are supposed to hedge risk. But when markets move in unexpected ways, these hedges can turn into massive liabilities overnight. Remember what happened with Credit Suisse? They had derivative exposure that dwarfed their actual capital. When confidence evaporated, those derivatives became toxic. The bank that had survived 2 world wars, the Great Depression, and countless financial crises couldn't survive a crisis of confidence in the modern derivative-laden banking system. They were absorbed by UBS in a weekend. A weekend. That's how fast things can move now. And here's the connection to gold that most people miss. Gold is the ultimate confidence barometer. When people trust the system, they don't need gold. They're happy holding dollars, or euros, or yen. They're happy keeping their money in banks. But when that trust starts to erode, even slightly, gold becomes attractive. Not because it pays interest, not because it generates cash flow, but because it's the one asset that doesn't depend on someone else's promise. Think about what a dollar really is. It's a promise from the government. A promise that this piece of paper or this digital entry in a computer will be accepted as payment and will hold its value. That promise has been pretty reliable for most of our lifetimes. But promises can be broken. And when you look at the debt levels, when you look at the deficit spending, when you look at the political dysfunction, you start to wonder how much longer that promise can hold. Gold doesn't make promises. Gold just is. It's been valuable for 5,000 years. It survived the collapse of every empire, every currency, every financial system ever created. And it will survive whatever comes next. That's why central banks hold it. That's why wealthy families accumulate it. And that's why it's surging right now while banking stress builds in the background. Let me tell you about something that happened in the 1930s that almost nobody talks about. Before the Great Depression fully hit, there was a period where everything seemed fine on the surface. The stock market was still near its highs. Banks were still operating normally. But gold was moving. People who understood monetary history were quietly converting their dollars to gold. Not because they were paranoid, because they understood the math. The government had printed too much money relative to the gold backing it. The ratio was unsustainable. And when Roosevelt took office, one of his first acts was to confiscate gold from American citizens and revalue it higher. People who had held dollars lost purchasing power overnight. People who had held gold, even though they were forced to sell it, at least got the revalued price. The difference was enormous. Now, I'm not saying we're headed for gold confiscation. The circumstances are different. But the principle is the same. When the monetary system is under stress, when the banking system is fragile, gold protects you in ways that paper assets simply cannot. And right now, both the monetary system and the banking system are showing serious signs of stress. Look at what's happening with bank lending standards. They're tightening. Banks are becoming more selective about who they lend to. That's not a sign of strength. That's a sign of fear. When banks are confident, they lend aggressively. When they're worried about defaults, about their own capital positions, about the economic outlook, they pull back. And they're pulling back right now. The Federal Reserve's own survey data shows this. The percentage of banks reporting tighter lending standards has been climbing. And historically, when lending standards tighten significantly, a recession follows within 12 to 18 months. Not might follow. Follows. It's one of the most reliable leading indicators we have. And gold knows this. Gold is pricing in the recession that most people still don't see coming. But it's not just about recession. It's about what happens during and after the recession. Because the government's response to economic weakness is always the same. Spend more money, print more currency, bail out the banks. And every time they do that, every time they expand the money supply to paper over the problems, gold benefits. Because gold is the antidote to currency debasement. Here's something that should concern you. The federal deficit is running over $1.5 trillion annually. That's during what's supposed to be a strong economy. What happens when the economy weakens? When tax revenues fall and spending on unemployment benefits and stimulus programs soars? The deficit could easily double. And how do you fund a $3 trillion deficit? You print money. There's no other option. And when you print that much money, when you flood the system with new currency, the value of each existing dollar has to fall. It's simple mathematics. More dollars chasing the same amount of goods and services means higher prices, means inflation. And inflation is a hidden tax on everyone holding dollars. But it's not a tax on people holding gold. Gold maintains its purchasing power through inflationary periods. It always has. Let me give you a specific example. In the 1970s, inflation was running rampant, double digits. Your savings account was losing purchasing power every single year, even with the interest it was earning. But gold? Gold went from $35 an ounce to over $800. While the dollar was losing value, gold was preserving and multiplying wealth. The people who understood this, who positioned themselves accordingly, came out of that decade far wealthier than those who just held cash. We're seeing the early stages of a similar setup right now. Inflation has been more persistent than the Federal Reserve expected. They've had to keep interest rates higher for longer, and those higher interest rates are now creating stress in the banking system. It's a vicious cycle. They raise rates to fight inflation, but higher rates damage bank balance sheets and slow the economy. Then they'll have to cut rates and print money to prevent a complete collapse. And when they do, gold will explode higher. The smart money knows this. That's why you're seeing record inflows into gold ETFs. That's why physical gold dealers are reporting shortages of popular coins and bars. That's why central banks are accumulating at record pace. They're all positioning for the same outcome, a banking crisis followed by massive monetary expansion. And they want to own gold before the general public figures it out. Because here's the thing about gold. When everyone wants it at the same time, the price can move violently higher. The gold market is actually relatively small compared to other asset markets. The total value of all the gold ever mined is around $15 trillion. That sounds like a lot until you compare it to the global bond market, which is over $130 trillion, or the global stock market, which is over $100 trillion. If even a small percentage of money in bonds or stocks decides to move into gold, the price impact would be massive. We're talking about a potential move that could dwarf what we saw in the 70s, because there's more money in the system now, more debt, more leverage, more risk. And when that risk starts to materialize, when the banking stress turns into banking failures, the rush to gold could be unlike anything we've seen in modern history. Now, if you're sitting on retirement accounts, if you've got $100,000 or more in IRAs or 401ks, you need to understand something. Those accounts are likely heavily weighted towards stocks and bonds, traditional assets. And those traditional assets are going to struggle in the environment we're heading into. But there's a way to get physical gold into your retirement account without triggering taxes or penalties. It's called a gold IRA, and I've put together a comprehensive guide on exactly how it works. You'll find it in the description. It covers the rollover process, the tax implications, the custodian requirements, everything you need to know. If protecting your retirement from banking instability and currency debasement matters to you, it's worth checking out. Let's talk about what happens next. Because the pattern is clear if you know what to look for. Gold rallies first, then the banking problems become public, then the government intervenes, then gold rallies even more on the intervention. We saw this exact sequence in 2008. We saw it in the European debt crisis. We're seeing it again right now. The intervention is always the same playbook. Guarantee deposits, provide emergency lending, merge failing banks with stronger banks. And if that's not enough, direct bailouts. Every single one of these actions requires printing money, expanding the central bank balance sheet, debasing the currency, And every single one of these actions is bullish for gold. But here's what's different this time, the starting point. In 2008, the Federal Reserve's balance sheet was under $1 trillion. They had room to expand it. Now, it's still over $7 trillion even after they've been trying to reduce it. The debt to GDP ratio is at levels we haven't seen since World War II. The government's fiscal position is far weaker, which means their ability to respond to a crisis without causing serious currency problems is limited. And the market is starting to price this in. Look at the yield curve. Look at credit spreads. Look at the volatility in currency markets. These are all flashing warning signs, the kind of warning signs that preceded every major financial crisis of the last 50 years. And gold is responding exactly the way it should. It's rallying hard, breaking out to new all-time highs, telling anyone who's paying attention that something big is coming. The question isn't whether we're going to see banking stress turn into a broader crisis. The question is when, and how severe, because the underlying problems haven't been fixed. They've been papered over with cheap money and government guarantees. But you can't paper over structural problems forever. Eventually, reality reasserts itself. And when it does, the repricing can be brutal. Think about the average American's financial situation right now. Credit card debt at record highs, auto loan delinquencies rising, student loan payments resuming after years of forbearance, savings rates near zero. These people are not prepared for a banking crisis. They're not prepared for a recession. They're barely prepared for a minor economic hiccup. And when the stress hits, when layoffs start, when credit tightens further, the defaults are going to cascade through the system. And who's on the other side of all those loans? Banks. The same banks that are already dealing with underwater bond portfolios and commercial real estate exposure. The same banks that are seeing deposit outflows. The same banks that are tightening lending standards because they're worried about their capital positions. This is how systemic crises build. Slowly, at first, then all at once. Gold is telling you that the all at once part is getting closer. The technical breakout we're seeing isn't just a random price move. It's a signal that the smart money, the central banks, the family offices, the people who have access to the best information and analysis in the world are positioning for a major financial event. And they're using gold to do it. Here's what you need to understand about gold's role in a portfolio. It's not about making a quick profit. It's about insurance. It's about having an asset that maintains its value when everything else is falling apart, when banks are failing, when currencies are being debased, when governments are making desperate policy decisions. Gold is the anchor. It's the asset that doesn't depend on the financial system functioning properly. And that's becoming more valuable by the day, because the financial system is showing more and more signs that it's not functioning properly. The stress in the banking sector is real. The derivative exposure is real. The commercial real estate problems are real. The government debt burden is real. These aren't conspiracy theories. These are facts. Documented, verifiable facts. And gold is responding to these facts in exactly the way history says it should. Let me tell you about a conversation I had with a banker friend of mine recently. He works at a regional bank, mid-sized institution, and he told me something that chilled me to the bone. He said their deposit base has shrunk by 15% in the last year. 15%. And to cover that, they've had to sell bonds at a loss and borrow from the Federal Home Loan Bank system. They're paying more for funding than they're earning on their loan portfolio. And management is starting to talk about branch closures and layoffs. This is happening at banks across the country, not making headlines, not causing panic, but happening. And it's unsustainable. You can't run a bank at a loss indefinitely. Eventually, either the situation improves or the bank fails. And with the economic headwinds we're facing, with the interest rate environment we're in, improvement seems unlikely in the near term. So what happens when these banks start failing? The FDIC steps in. They guarantee deposits up to $250,000. But where does the FDIC get the money? From the banking system itself through insurance premiums. And if the failures are large enough, if multiple banks go down, the FDIC fund can be depleted. Then what? The government has to step in with taxpayer money, more debt, more money printing, more currency debasement. And through all of this, gold will be rising. Because gold is the market's way of saying, I don't trust this system anymore. It's the vote of no confidence. And right now, That vote is getting louder and louder. The price action is unmistakable. The breakout is real, and the implications are profound. I want you to think about your own financial situation for a moment. How much of your wealth is dependent on the banking system functioning normally? Your checking account, your savings account, your brokerage account, your retirement accounts. All of it depends on banks being solvent, on the payment system working, on the government backing up its promises. What happens if even one of those assumptions breaks down? This isn't fear-mongering. This is risk assessment. And proper risk assessment says you need to have some portion of your wealth in an asset that doesn't depend on the system, an asset that has value regardless of what happens to banks or currencies or governments. And for 5,000 years, that asset has been gold. The pattern we're seeing right now, the banking stress combined with gold's breakout, is historically significant. It's the same pattern that preceded the collapse of the Bretton Woods system, the same pattern that preceded the savings and loan crisis, the same pattern that preceded the 2008 financial crisis. And it's happening again, right now, in real time. The question is, what are you going to do about it? Are you going to wait until the crisis is obvious to everyone? Until gold has already doubled or tripled from current levels? Until banks are failing and the government is implementing emergency measures? Or are you going to position yourself now, while there's still time, while gold is still accessible, while you can still make rational decisions without panic? Because here's the thing about financial crises. They always seem impossible until they're inevitable. In 2007, if you told people that Lehman Brothers would collapse and the entire financial system would nearly implode, they would have called you crazy. In early 2020, if you told people the government would shut down the entire economy and print trillions of dollars, they would have laughed at you. But both of those things happened, and the warning signs were there for anyone paying attention. The warning signs are here again. Gold is screaming at you. The banking sector is showing stress. The government's fiscal position is deteriorating. The economic data is weakening. The pieces are all in place for another major crisis. And the people who understand this, who study history, who pay attention to what gold is telling them, are positioning themselves accordingly. I've been studying gold and financial markets for decades. I've seen multiple cycles, multiple crises, multiple opportunities, and I can tell you with absolute certainty that what we're seeing right now is significant. This isn't a normal market environment. This isn't a routine correction or a temporary blip. This is the early stage of something much larger, something that will reshape the financial landscape, something that will create massive winners and massive losers. The winners will be the people who saw it coming, who understood what gold was telling them, who took action before the crowd. The losers will be the people who ignored the warning signs, who trusted that the system would always work, who waited too long to protect themselves. Which group do you want to be in? Look, I know this is heavy stuff. I know it's uncomfortable to think about banking crises and currency debasement and financial system instability. Most people would rather not think about it at all. They'd rather just assume everything will be fine, that the government will handle it, that their money is safe. But hope is not a strategy, and assuming everything will be fine when all the evidence points to serious problems is not prudent. It's dangerous, because when the crisis hits, when the banking stress turns into banking failures, when the currency debasement accelerates, it will be too late to protect yourself. The opportunity to position defensively will have passed. That's why gold is moving now. That's why central banks are buying now. That's why the smart money is accumulating now, because they understand that the time to prepare for a crisis is before the crisis, not during it. And they're using gold as their primary tool for that preparation. The historic nature of what we're witnessing cannot be overstated. Gold breaking out to all-time highs while banking stress builds in the background is not a coincidence. It's a pattern that has repeated throughout history, a pattern that always ends the same way, with a crisis, with intervention, with currency debasement, and with gold significantly higher than where it started. You have a choice to make. You can ignore this information. You can hope that this time is different. You can trust that the system will hold together despite all the warning signs, or you can take action. You can allocate some portion of your wealth to gold. You can protect yourself from what's coming. You can position yourself to not just survive the crisis, but potentially thrive through it. And if you've made it this far, if you've watched this entire video, you're clearly someone who takes this seriously. Someone who understands that the financial world is changing. Someone who wants to protect what they've worked so hard to build. That's exactly who I created that free guide for. The one in the description. It's comprehensive, it's actionable, and for those who qualify, for American retirees with at least $100,000 in retirement accounts, I'm offering a free one-on-one educational web conference. No obligation, no pressure, just information and guidance from someone who's been through multiple financial cycles and knows how to navigate them. The banking crisis that gold is predicting isn't a matter of if, it's a matter of when. And the when is getting closer every day. The stress is building. The warning signs are multiplying. The smart money is positioning. And gold is telling you everything you need to know if you're willing to listen. Don't wait until it's too late. Don't wait until the crisis is obvious to everyone and gold has already made its major move. Take action now. Educate yourself. Protect your wealth. Position yourself for what's coming. Because what's coming is historic, and those who prepare will be glad they did.